Hi everybody, thank you for stopping by. My name is Yulius and I'm a student in the Executive MBA IPMI International Business School in Jakarta. This video is actually an assignment of a corporate finance class taught by Professor Sembel. The assignment is to summarize the lesson that we learned during the 8 weeks of class, and the goal of class is to give the student problem solving skill in finance from the point of view of management internal and investor external. There are actually 8 weeks of class. We can see the topic covered in the class. But these 8 weeks, I group into 6 category. One is the main concept. Second, the capital budgeting. Third is the financial market. Fourth is the capital structure. Fifth, ethical, and sixth, special topics. The goal of financial management is the optimal orchestration of internal and external financial resources towards significant and sustainable value creation. So the main idea that we want to emphasize here are significant. That means it's not a small amount, and sustainable. That means it needs to be continuously. In short, it is to maximize wealth and maximize profit. Financial management. We start with what to manage. There are 8 points that we need to manage. The first is capital structure. Second, working capital management. The third, asset structure. Fourth, revenue management. Fifth, cost management. Sixth, cash flow management. Seven, growth management. And 8, risk management. To measure whether we have done a good job or not in managing this thing, we need numbers. So numbers is very important. However, people can be deemed as more important, because from the people we know the story behind the numbers, and also we can have a prediction on what's going to happen in the future. To ensure that the numbers are correct and people will behave according to the boundary, good governance is needed. The principles of good governance are transparency, accountability, responsibility, independency, and fairness. Next is the business principle. There are 4 cornerstones of the corporate finance. The first one is the core value principle. A good business needs to create value. And basically, the combination of growth, return of invested capital, and healthy cash flow is the one that drives the value creations. At the end, the growth and the ROIC should generate healthy cash flow. The second, the activities in the business needs to create value. Increase growth, create ROIC, create cash flow. If not, that means the activity is only moving value from one pocket to another. The result of activities that create value is the higher cash flow. And then we have the best owner principle. Owner bring value to the business. To bring the best value, it needs to be with the best owner. Different owner will have different strategy and unique ability to add value. And also it will bring different strategy synergies with other businesses that he might have. The next is the expectation treadmill principle. The higher expectation means that the company needs to keep up. The expectation from shareholder will drive the company better. But of course, we need to balance out between the expectation and the actual capability of the company. The last we have the 5 business essential from Professor Ramcharan, yeah, which is cash, profit margin, velocity, growth, and customer focus. Goal versus reality. Just like marriage, the one in the picture here, yeah, people come into relationship with a certain intention and goal, often with goals that seems to fit with each other. But very soon, a problem will arise. Principal and agency problem is when the owners or shareholders hire managers to operate the firm, but the managers might not act in a way that maximize the shareholder wealth. What caused the problem are coming from these 3 factors. Yeah, one is conflict of interest, second misinformation, and third moral hazard. Thus, to avoid the situation, that's why we need to have a good governance with the 5 pillars. Yeah, the first pillars is transparency, second accountability, third responsibility, fourth independency, and fairness. There are many things that people have done to avoid this principal agent problem. Yeah, several that people have done is the contract design and also performance-based compensation. The next is capital budgeting. So the concept of capital budgeting is basically coming from time value of money. Value of money basically taking value of money now and estimate the value in the future, or taking the value in the future and calculate what is the value now to make decision whether this investment is more profitable or not than the others. There are 3 ways to measure this. We have profitability index, IRR, which is internal rate of returns, and also net present value. Next is the financial market. In the financial market, the first thing is analysis of security. Yeah? Here we look at the concept on how we do investing. There are 2 ways of doing investing. One is the passive investing, which is just follow the market, put in a time deposit and just follow, and also active investing. The active investing, we need to look at a few factors. One is the fundamental, second technical, third market and investor sentiment. In the fundamental analysis, we look at the domestic and global economic analysis, industry analysis, and the company analysis. By having this analysis, basically we want to establish what is the intrinsic value of the investment that we're looking at. This is calculated by investor, and it is basically discounted future cash flow. And by establishing this intrinsic value, we can look at whether we want to buy, sell, or hold. Yeah, the intrinsic value, if it is more than the market price, then the recommendation is to buy. The intrinsic value, if it is less than the market price, then we sell or short sell. And if intrinsic value is equal market price, it is a hold or wait and see kind of situation. To do company analysis, we usually do analysis on the financial statement. And there are 3 financial statements that we use, balance sheet, income statement, and cash flow statement. And then we use the ratio to standardize the value so that we can compare it to the others. One highlight that was discussed during the class, that was the class made a mistake when we judged a company just based on the 1-year performance. So basically, the company, we thought the company was a bad company, yeah, and then it end up to be a good company that later on perform very well. Yeah, so one thing that we learn is that historical will tell a more complete story on what phase or what situation that the company is in right now. Next is a financial market. Yeah, financial market is a place to bring together borrowers and lenders to trade financial assets. What are financial assets? There's stocks, bond, commercial paper, treasury securities. And then the category of financial markets, we have primary and secondary market. Primary is where the company issue their own stock or bonds. And then secondary market is where investor sell and buy securities to another investor. And then we have money market, which is for short-term debt instrument. And then capital markets is for the long-term securities. The next is capital structure. To create asset, we can have debt and equity, but debt is actually deemed as a cheaper alternative because debt is tax deductible. But we must balance this with the benefit of increased financial risk because of higher debt. The capital structure I divide into three subtopics. The first one is the financial analysis, and then we have debt and equity in capital structure, and then corporate restructuring. Financial analysis, as we discussed earlier, this is basically analyzing a ratio based on the financial statement. So there are 5 types of ratio that we look at. The first is the profitability, second liquidity, third activity, fourth leverage, fifth the market ratio. The way we use this ratio is basically to standardize the financial information so that we can compare it to the others, and we can review the performance along the time. Yeah. The company resources or asset will be reported in the balance sheet, and what we are looking at this balance sheet is that this asset is being used to create profit, that it is actually reported in the income statement. So to actually analyze the company, whether it's not healthy or not healthy, yeah, we can look at the natural level. For example, the current ratio is more than 1. And then we look at the quality of number by comparing or taking account on several ratios. Looking at the historical trend, whether it is getting better or worse. And then industry benchmark, whether it is above or below its competition in the industry. And decomposition, DuPont analysis. As mentioned, there are many ratios. Yeah, each will have their own interpretation on the company performance based on the market situation, liquidity, profitability, efficiency, and leverage. But we are not going to cover this one by one. This information will then further analyze using the DuPont analysis, where it brings the relation and cost effect of this ratio to overall performance of the company. With DuPont analysis, we can pinpoint to improve a company performance on what area that we need to improve on. The next is debt and equity as in the capital structure. Debt is cheaper than equity because it is tax deductible. But it does come with a cost, yeah. because the public will see it as riskier. The company will want to balance the cost and benefit of debt. The initial impact of having debt, it will usually lower the weighted average cost of capital, but at a high level, it will lower the company value, as I mentioned earlier, because it's perceived as riskier. As we see here, there's a theory actually that we need to find the optimal debt ratio to get the best value of the company. So when undergoing financial distress, company will go down in a step like this. Yeah, it will come from early impairment and then deterioration of performance, cash flow problem, failure, default, insolvency, and actually it will end up in bankruptcy. When company undergo a financial distress, on one hand, it can go down with a permanent problem, where eventually end up with a bankruptcy. On the other hand, it may have a turnaround opportunity. To turn around, there are several steps. The first one is to stop the bleeding. Second is financial restructuring. The third, the fourth, the fifth, and the sixth are basically having to do with the business, which is temporary pivoting, strategic realigning, redefining core business, and new way of doing business. The financial restructure means restructure those included in the 8 items to manage in the financial management. Corporate restructuring topic, we actually get a very interesting case. It is a Nabisco case. In this case, there's a story about a management team that wants to take over a company below its value. Yeah. Later, it is countered by another party, KKR, in the bidding war. One interesting concept that was introduced here is the leverage buyout. Leverage buyout is using debt to buy equity, and then also to buy the controlling stake, and then also to perform the restructuring. There are 3 ways that LBO can benefit a company. The first one is the operational improvement. Yeah, in the operation improvement, the value of asset will grow as the cash flow grow. And then we have debt expansion. Yeah, in a debt expansion, the value of equity will grow as debt is being paid with the cash flow. And then multiple expansion. Multiple expansion is basically the value of asset grow with multiple expansion. The corporate restructuring section, I find it is a very interesting section. And I will close it with a good quote from the Wall Street movie. Greed, for the lack of better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the sense of evolutionary spirit. Greed in all of its form. Yeah, by Michael Douglas. Yeah. So what it means by this, right? Greeds actually fuel the improvement. Yeah, it is not greed as in bad greed, but the intention to excel actually fuel the improvement. The next study is ethic. Yeah, we watch a movie. The group, our group, Money Money Money, watch a movie, Rogue Trader. Yeah, the Rogue Trader is actually telling a real story of a person, a trader in Singapore, who found a flaw in the system and then performed unsanctioned transaction that caused financial damage even bigger than the company itself. There are three factors that actually play into part in fraud. The first is pressure, second opportunity, and then rationalization. And then there are many ways to control fraud. Yeah, we see it here. Control, we can, from the control point of view, we can have SOD, audits, review policy, and then to control the justification or rationalization factor, we increase the commitment, we perform fair treatment, building relationship, building team building. And then in terms of pressure factor, we should establish a realistic goal. We do a performance expectation, the clear performance expectation, financial planning, and services. The last topic is the special topic. It is divided into three topics. The first is fraud risk management, second, international finance, and then dividend policy. The fraud risk management we touched on earlier. International finance basically talking about how different countries interact with each other. And this is actually affected by local demand and local supplies of foreign goods and foreign securities, and also how the foreign demand and foreign supply of local goods and local securities. And then dividend policy, basically looking at how the firm's retained earning to be distributed. One way is distributed back to the shareholder as dividend, and then the other way is to use it as a capital investment or expansion. This needs to be balanced, and one thing that it was actually discussed in the class, that the importance of paying dividends is to demonstrate that there is actually cash, from the financial statement that they have. With this is actually the end of the finance class summary. Of course, I would like to thank Pak Roy and my classmates for wonderful learning experience. And then a special shout out to my group, Money, who have assisted and support me, and then also helped me and making the learning fun. Special thanks, this is not in particular order, because I'm too lazy to actually rearrange the sequence. Special thanks to Pak Is, Bu April, Bu Dewi, Pak Iri, and the wonder boy, Mr. Juventus. With this, I would like to close it with a poem. Saturday morning, I need to hurry because we have Pak Roy's class. Even though the class is now finished, I'll always remember to have a nice breakfast. Thank you for stopping by. Have a good day, everybody. Thanks.